Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Mergers and acquisitions are major decisions that can transform a company by reshaping industries, creating synergies and driving growth. But they also carry risks that can lead to value loss if not managed well. One key way to assess the financial impact of a deal is through accretion and dilution analysis, which looks at whether the transaction will increase or decrease the acquiring company's earnings per share, or EPS. In simple terms, accretion means the deal boosts EPS, while dilution means it lowers EPS. This analysis is important because it helps leaders, investors, and analysts understand the potential immediate financial effects of a transaction, guide deal structuring, and communicate with shareholders. While EPS impact is not the only factor in deciding whether a deal is successful, knowing how to evaluate accretion and dilution is an essential skill for anyone involved in corporate finance or strategic decision-making. The basic EPS formula divides net income by the weighted average shares outstanding, and this calculation is at the heart of understanding how a merger or acquisition will affect shareholder value. An acquisition impacts earnings per share through two main ways. First, by changing earnings, which includes additional profit from the acquired company, synergies, financing costs, and amortization. And second, by changing the number of shares outstanding, especially if new shares are issued to partly or fully finance the deal with stock. Deals are often described based on their effect on EPS. If the combined company's EPS is higher than before, the deal is accretive. If it stays the same, it's neutral, and if it's lower, it's dilutive. It's important to note that this analysis typically focuses on near-term EPS, often looking at the first full year after the deal closes, and does not directly capture long-term strategic benefits or growth opportunities. From a practical standpoint, accretion and dilution analysis helps businesses quickly evaluate the financial impact of different acquisition options and decide which targets and deal structures are most favorable. For example, a deal funded mostly with low-interest debt might be immediately accretive, even if the acquired business is only modestly profitable, while a stock-funded acquisition of a fast-growing company might be initially dilutive. Market reactions to M&A announcements often hinge on this metric as well. Accretive deals tend to be well received, particularly in mature industries, while dilutive deals can cause share prices to drop unless management clearly explains the long-term value. It's common for executives to emphasize that a transaction will be immediately accretive to EPS to reinforce positive market perception. This kind of language reassures investors that the deal won't hurt short-term earnings, even if synergies take some time to show up. EPS is essential because it ties directly to executive pay, analyst predictions, and how the market values the company. Accretion and dilution analysis helps the board figure out if management's incentives line up with what shareholders want, and whether the deal is about financial discipline or just growing the empire. Financing decisions play a big role too. Debt finance deals often look better for EPE since interest is tax deductible, while equity deals can increase shares and risk dilution. This analysis helps companies find the right capital structure when making acquisitions. To start an accretion or dilution analysis, you first establish the acquirer's standalone EPs by looking at the latest net income and shares outstanding. For example, if net income is £500 million and shares outstanding are 250 million, the EPS is £2. Then you determine the purchase price and how the deal will be funded, cash, debt, or equity. For instance, a £1.5 billion deal might be half debt and half equity. These steps set the foundation for understanding how the acquisition will impact earnings per share. To estimate the target's contribution to earnings, we start by looking at their net income, which in this example is £120 million, calculated on a consistent accounting basis. Next, we need to adjust for financing effects by considering incremental interest expenses on any new debt and any lost interest income on cash. For instance, if debt financing of £750 million is used at an after-tax cost of 4%, that results in a £30 million interest expense. Then we factor in synergies and transaction costs. This includes adding cost synergies such as savings in IT, overhead and procurement, and possibly revenue synergies though these are often excluded in conservative assessments. From this, we subtract integration costs and the amortization of intangibles. In the example, the net synergies after costs come to £20 million in the first year. Finally, we calculate the pro forma net income by adding the acquirer's income, the target's income, and synergies, then subtracting financing costs using the numbers provided. This works out to £500 million plus £120 million plus £20 million minus £30 million, resulting in £610 million. This gives us a clear view of the combined earnings after accounting for all these factors. To calculate the pro forma EPs, we start by adding the new shares issued, 37.5 million, to the existing 250 million shares, which gives us a total of 287.5 million shares. Then we divide the combined earnings of £610 million by this new share count, resulting in a pro forma EPS of £2.12. Comparing this to the pre-deal EPS of £2 shows that this transaction is 6% EPS accretive, meaning it increases earnings per share. To put this in perspective, real-world examples help illustrate how this plays out. When Disney acquired Pixar in 2006, the initial stock issuance caused some dilution, but the long-term benefits through brand value and creative renewal made the deal accretive over time. Similarly, Facebook's acquisition of Instagram was initially dilutive because Instagram had limited revenue, yet its strategic value led to significant long-term EPS growth. These examples show that while short-term EP's impact is important, understanding long-term strategic value is crucial for assessing M&A success. The Kraft-Heinz merger initially showed an increase in EPs thanks to cost synergies and aggressive margin expansion. However, later write-downs and slow organic growth revealed the risk of relying too heavily on financial engineering instead of building sustainable revenue growth. One of the key advantages of accretion and dilution analysis is its simplicity and speed. It gives a clear quantitative result quickly, making it useful for early deal screening. It's also relevant to the market since EPS is closely watched by analysts and investors, so evaluating deals through this lens aligns decisions with market expectations. Additionally, it provides insight into how financing choices affect shareholder outcomes, which helps make more disciplined funding decisions. This type of analysis also promotes decision discipline by acting as a check against emotionally driven or empire-building acquisitions. On the downside, it focuses mostly on short-term EPS, which can overlook investments that carry long-term strategic value. EPS figures can be distorted by accounting policies, amortization rules, or synergy assumptions, sometimes hiding the economic reality. Finally, there is a tendency for companies to prefer debt-funded deals to boost EPs in the short term, which can increase financial risk and leverage. EPS accretion alone doesn't guarantee that an acquisition creates value. A deal can increase EPs yet still destroy value if the price paid is higher than the company's cost of capital. To get a complete picture, it's important to combine EPS analysis with measures like NPV and IRR, and to look at different scenarios, including conservative and optimistic cases. It's also crucial to separate real operational synergies from accounting effects, and to be careful about assuming revenue synergies will materialize quickly, especially early on. Communicating the long-term strategy alongside EPS impact helps maintain perspective beyond short-term earnings. While accretion and dilution analysis is a fundamental part of evaluating mergers and acquisitions, helping with deal screening, financing, and investor communication, it should be seen as a diagnostic tool rather than a decision-making rule. The best acquirers integrate this analysis with broader strategic, economic, and qualitative factors to ensure that deals truly enhance shareholder value over time, rather than just superficially boosting earnings. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.